Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. And what we want to talk about today is a risk that we are seeing in community banks, and it's a rising risk. And that risk is liquidity risk. And you sit there and scratch your head and you say, well, Jay, this isn't like it was back in 2006 where so many banks were really running very high liquidity risk. In fact, the banks that failed just wasn't credit risk that put them down. It was all the risks, including liquidity risk. So when we look at liquidity risk in here is that we have to look at it in a different way than maybe you look at it in terms of your policies. Because this liquidity risk is a growing concern that we see at a number of the different ALCO committees that we deal with in here. And what's happening out there is that it's different than the liquidity risk that we normally think of. We think of liquidity risk based upon having higher costs of money, not having cash available when needed. So when we look at that, this is a different type of liquidity risk. This is having too much liquidity and growing liquidity. We've talked about this before in previous webcasts that we're seeing the duration on loan portfolios shortening dramatically in here. So once again, what this is causing is the loan portfolios to walk in and become shorter term, but also have more cash flow. On top of that, what is happening is if you've looked at your mortgage-backed portfolios here over the past month or so, you probably have seen a higher level of prepayments. So even in the mortgage portfolio that you might have in terms of mortgage loans, but looking at the overall MBS portfolio with mortgage backs, we've even been seeing 3.5% and 4% pools paying down at very rapid rates. Once again, shortening this duration down, bringing in more cash flow. And this is a risk because the question is that most likely you're not able to replace the yields with new loans, new securities, and so it presents an overall risk that can affect the net interest margin. Now it would be good as if interest rates started to go up and you had all of this liquidity. But as we've talked about before, where it seems that the regulators are so worried about interest rates heading up, the real worry in my mind is if interest rates stay down at this level for an extended period of time, which the Fed is indicating. So when we look at this is that we need to figure this risk out in every community bank. The boards, the management team need to understand what the size of this liquidity risk is. Is it manageable? Is it something that you need to take certain actions on? The thing is that you need to be able to define it. For instance, when we were with a management team meeting yesterday and we were going over this whole liquidity in terms of the loan portfolio liquidity for this bank over the next year, is that suddenly they were looking at their budget in a very different way, looking at their loan products in different ways. So to sit there and say, to be able to collect the volumes, because this bank didn't expect their loan portfolio to really grow much next year, but when they realized the huge volume of loans that they had, and they also have their mortgage-backed securities starting to pay down faster, that suddenly they need to take a certain action plan into step and be able to really correct this overall problem. But once again, the ability to model your balance sheet, which I say over and over again, is very important in here to understand how big this risk is. And we need to look at it from the standpoint of policies in here. One needs to look at your overall liquidity policy, that it's not based on the liquidity ratios. The liquidity ratios that the regulators require, we look at as being more warning signs and event triggers rather than the actual cash flows, which are much more important in here. So you want to make sure that your model is able to look at this and be able to sit there and say, what kind of volumes do we have coming up over the next year based upon interest rates staying where they are? Then number two, sitting there looking at the rates coming off so that one can manage their cost of funds as well as manage their loan portfolio growth in order to be able to maintain the margins. Once again, this liquidity risk is one that's sneaking up on banks, and there's a realization that has to occur. This is Jay Brew, co-chairman of Seafried & Brew. Have a good week.